that leaving work just a few years before Medicare could easily cost over $100,000 from your retirement savings. In this video, I'm going to break down everything that you need to know about retiring before Medicare. We're going to go through all of your health insurance options and how you can incorporate those into your retirement plan before you retire. Now, before we do that, if you caught our last video, I had talked about a couple that wanted to retire at 65 years old, and I went through step by step how we helped that couple's retirement plan. If you didn't catch it, I'm going to link it right here, but the reason why I bring that up is because one of the things that I mentioned in that video made a lot of people reach out. I thought about the most common age that I've seen people start thinking about retirement, and that's 65 years old. Everything basically came back to the same question. What if I wanted to retire before Medicare? Hello and welcome back to the Think Retirement channel, where today we're going to be talking about all of your health insurance options between early retirement and Medicare. And for those that are new to the channel, I'm Jonathan Rankin. I've been helping people plan and execute their retirement goals to live a comfortable retirement for going on 20 years now. Now, the last thing that most people want in the first few years of retirement is a surprise. I mean, a surprise in retirement is like being at the ATM at 2 in the morning. There's a very small chance that it's going to be for something that's actually good. Our research has shown that 70% of Americans actually retire before they're eligible for Medicare, whether that's because they were forced to retire or they chose to retire. Almost everyone that I talk to about planning for retirement at some point during the conversation is going to bring up healthcare in retirement. But it's usually in the form of planning for the increased cost of medical services as they age. But in reality, for most of them, the more immediate concern eventually becomes healthcare costs right out of the gate. And that catches many of them off guard. You see, when planning for retirement, most people focus on their current expenses that are required to maintain their lifestyle. Maybe they're going to add an additional spending goal, for things like travel or, buying a second home. But for those that are retiring from a company that subsidizes or even covers their cost of health insurance, replacing coverage can be a rude awakening. And it can run well over $25,000 a year, which means that leaving work just a few years before Medicare could easily cost over $100,000 from your retirement savings. On top of that, certain insurance plans offer only a restricted local network, and that might not cover preferred doctors or special visits to specialists without a referral. To add to an already frustrating situation, many plans don't cover out-of-state expenses unless it's an emergency, which could be a huge drawback for retirees that want to live in different parts of the country. When I lived in Arizona, we called these people snowbirds. When it snowed where they were at, they came to where we were, where it was nice and sunny. So if you think that health insurance is going to be identical to what you have while you're working, our hope is that this video is going to help you plan for what you actually can expect. Now let's go over the 4 different options to help you bridge the health insurance gap before Medicare kicks in. Now, the first option is the cheapest option, and this is available only to couples. If you're married, you could consider staggering your retirements, allowing one partner to continue working so that both can maintain coverage under that workplace plan until they become eligible for Medicare. Now, workplace plans are generally more affordable because the employer typically covers over 80% of an employee's insurance costs, according to research. On top of that, workplace plans usually offer a broader coverage compared to private insurance that's purchased individually. Now, the problems with this strategy. Well, it's not going to work if you're single, and it's not going to work if both partners don't want to delay retirement. And if you both want to retire as soon as possible, how do you decide who gets to retire first? I mean, is this a coin flip kind of situation, or is it who has better benefits? I mean, I can only imagine the debates that happen at the dinner table when trying to decide which one of the spouses gets to retire first. Now, if you both decide to retire but want to keep the same coverage, then there is an option for you, and you can maintain your workplace coverage through COBRA. This option permits employees of companies to extend their health benefits for up to 18 months following job termination, whether it's voluntary or involuntary or other significant life changes like a reduction in work hours. Now, before you get too excited about this option, there are a few things you have to keep in mind. Now, while COBRA coverage offers continuity with your current doctors, I'm just going to say this, it's expensive. Employers generally require those that are using COBRA to pay the full cost of insurance plus a 2% administrative fee. Now, recently, the average COBRA premium for a family coverage was about $25,000 a year, including this fee, which is a huge increase from the average of $6,775 that employees are used to paying through their payroll deductions. Now, this is all according to the Kaiser Foundation, so your situation might be a little bit different, but from what I've seen with clients, it is expensive. Now, COBRA might be advantageous for individuals who leave their job in the middle of the year or later, especially if you've already paid a substantial part of your annual deductible. Because if you switch to another plan, that means you are going to have to face a new deductible, and that could have additional costs all within the same year. Now, COBRA coverage could be a good stopgap and usually works well for those retiring between 63.5 and 65. The next option you can consider, if you aren't worried about specific doctors or you're retiring much earlier than 63.5, would be purchasing health insurance through the marketplace that's established by the Affordable Care Act. Insurance that's purchased through the marketplace is usually less expensive than COBRA, and that's because many people qualify for subsidies. Even people with more than $200,000 in income qualify for subsidies depending on what part of the country that you live in. And one good thing about the marketplace is that you can no longer be denied coverage for any reason, even pre-existing conditions. This used to be a huge issue for a lot of people that were thinking about early retirement because finding affordable health insurance was really hard to find if you had a pre-existing condition. Under the Affordable Care Act, there are 4 tiers of coverage that you can choose from. There's platinum, gold, silver, and bronze. As you can imagine, bronze plans are the lowest premiums and the platinums are the most expensive. If you're wondering what kind of cost you're facing if you went this route, on average, a 63-year-old couple making $150,000 a year could get a $13,689 subsidy, which really helps cut down the premium of $26,439 for a silver plan. That cuts it almost in half. Subsidies can change depending on where you live and how much you make. For example, a couple in New York City that's pulling in about $250,000 might get a very small subsidy to help lower their premium. Plans from the marketplace are also generally more straightforward than the final option that we'll cover, which is private insurance, but we'll get to that in a minute. One thing to keep in mind, just by paying the premiums, that doesn't mean you're all set. These plans come with deductibles, and there are other out-of-pocket costs like copays and coinsurance for seeing doctors or going to the hospital or getting prescriptions filled. Take that average plan that we talked about earlier, that silver plan that costs $26,439. That couple might end up paying an additional $18,900 extra for doctors and hospital visits. And if they choose to see a specialist or go to a highly rated hospital outside of their network, they can end up spending even more money. So if you're planning on utilizing the Affordable Care Act marketplace, make sure you stick around to the end of the video because I'm going to share 5 key things that you need to heavily scrutinize when choosing your plan. Now, if you qualify for a subsidy, it's hard to pass up insurance from the exchange if you can't get coverage from a spouse's employer's plan. However, for those who don't qualify for a subsidy, you can buy private insurance one of 2 ways: direct through insurance agents or through the Affordable Care Act marketplace. Buying private insurance through the marketplace is going to cost you more than buying private insurance outside of the marketplace, but it might be the smarter option. And that's because there are so few private plans outside of the marketplace, and the ones that are out there don't offer coverage for pre-existing conditions like the ones bought through the marketplace. And this could become extremely important if a health issue did come up because private plans tend to reject claims if they find out that any illness relates to a pre-existing condition. So planning for an illness or a health issue in the future is like trying to time the exact move of the stock market on a certain day in the future. It's impossible. But if you buy private insurance with a cheaper premium just to save a few $100s today and end up getting denied for a claim that costs tens if not hundreds of thousands of dollars, that's like bending over to pick up a penny while dropping a $100 bill out of your pocket. In this case, it might not be worth the risk. Regardless of which option you choose, it's important to plan ahead. That means factoring in potential costs into your retirement plan to make sure that potential increases in spending doesn't cause any issue with the long-term viability of your retirement plan. Now, you may be watching this and thinking, how can I go about planning for healthcare costs in my retirement? Now, if that thought's crossed your mind and you would like some help, we would be happy to help you. There's a link in the description below, and a member of our team will be happy to walk through your specific scenario and help you model out exactly what healthcare costs might be costing you if you decide to retire before Medicare kicks in. Now, before we get out of here, I did promise to share 5 things that you should heavily scrutinize when choosing a plan through the Affordable Care Act marketplace. Now, for most people, the first thing they're going to consider is the premium. And while that is important, there are 5 things that are essential to making sure that you're choosing the best plan. The first is whether or not your doctors are covered in the plan that you're considering. Second is, are your prescriptions covered? Third is whether or not a reputable hospital is covered in the plan that you're considering purchasing. The fourth is, Can you see a doctor outside of your primary state? And the last thing that you should consider before jumping into any plan is, since you could be paying for a lot more things other than your premiums, what is your maximum out-of-pocket charge? Hope you found this video helpful. If you're thinking about retirement and want to know the steps that you should be taking to make sure that you're on track, make sure you check out this video coming up next, where I cover step by step what you need to do to see what kind of retirement you could have. I'll see you there.